Alright guys, so let's talk about the financial markets today. It's a big component of the economic war and a big point of leverage. Now the truce between the US and China isn't a full story. It's just the tip of the iceberg, and I would argue the terms actually self-sabotage the US economy. A 55% tariff rate on consumer goods is very painful for everyday Americans, and how could it not be? Trump's tariffs have jacked the average tariff rate from 1.5% to over 12% today. And if we head back to Liberation Day levels, the average tariff would be 25%. Now, we shouldn't hold our breath for US courts to strike that down. If they won't be able to succeed, Trump has managed to find a way to either appeal the orders or just bypass them completely. Now, prices in the US are significantly higher than before, and it will stay that way indefinitely for many years and maybe decades to come. Now, the weakness is already showing up in the data. Retail sales in April barely rose by 0.1%, while the March number hit a crazy 1.7%. In other words, people have stockpiled whatever they needed and now they're cutting back. And anyone would do the same thing. You buy everything you need, including domestic products. Very simple reasoning: when the tariffs hit, input costs for producers will rise, and there's no possible way for them to absorb all the price increases. But remember the stance from the White House. Besson has made it crystal clear that he's winning the tariff war. And when you're 100% convinced, nothing will stop this train.
There seems to be a new version of TDS, which I would call tariff derangement syndrome. And many on your side seem disappointed that there is no inflation today. As a matter of fact, we saw the best inflation numbers since 2020. So there has been nothing passed on. There has been no tariff recession. So no inflation, no recession due to tariffs.
But in China, the situation is quite different. While US consumers are suffering, Chinese consumers are actually starting to recover from their slump. Now, over the past 3 years, domestic spending has been stagnant. However, government stimulus is starting to work, and in quite a shock, domestic spending has overtaken industrial production. Now, in May, China's retail sales grew by an incredible 6.4%. Industrial output growth came in weaker than expected at 5.8%. So, within the Chinese economy itself, rebalancing is starting to happen. They are producing less and they are consuming more than what economists are expecting. It's the dream scenario that Scott Bessent wants, didn't he? However, it's not exactly ideal for China. What Beijing wants is for both their domestic consumption and their industrial production to grow at the same time. But it's not going to be easy at all. Now, when Trump launched his tariff war, not only did he crush US growth, he basically clobbered the world economy all at once. While US consumers have to pay higher prices, global exporters sell less. And for countries highly reliant on exports like Europe and Asia, this is a very big problem. It means less business for China as well. By 2030, the world economy might just be $1 trillion smaller thanks to the tariffs. Obviously, that would mean fewer customers looking to import stuff, looking to buy stuff. And for Beijing, this is a big problem. It's important to remember why China needs to be an export powerhouse. There are basically two big reasons for this. Now, the first is to ensure they stay on the cutting edge to maintain dominance, especially if they want to catch up in semiconductors with the US. But the second reason is perhaps even more critical. China wants to sanction-proof their economy, and the best way to do it is through trade, become a massive exporter to the world. And according to the World Bank, China's trade surplus in 2023 was a whopping $600 billion, and that's just in goods alone. We haven't counted in services yet. And as China grows their AI sector, that number will balloon higher as well. Having a monstrous surplus like that brings with it more than just financial clout. A ton of countries are now reliant on your affordable exports, and there's simply no way for the US to sanction you because they would have to essentially sanction the world, and that won't be a good look by any measure. And that's why Beijing is now looking to use their currency as a weapon in this trade war. It's something that Besson has warned Beijing against, not to manipulate their currency, but let's be honest, at this point anything goes. China needs to boost their export growth. Beijing is willing to pull the currency trigger. The RMB may fall by 3 to 4% in the short term, But this fall isn't just against the dollar, it's across a basket of currencies of China's major trading partners, which means Chinese goods get 3 to 4% cheaper just based on the currency effect alone. Now we are heading back to the 2020 levels just to help boost exports. And this is especially frustrating for the US. They want Chinese exports to collapse so that their own factories can produce more and to make their sanctions more effective as well. The US can't play that same card. The dollar is already falling, but thanks to the tariffs, input costs overall have gone up. So weakening the dollar even further will only hurt US consumers. They still rely heavily on imports. So China playing this card complicates the US trade war even further. The odds of transshipments will grow even higher. And now that Chinese goods have become even more attractive to trading partners, more countries around the world will buy Chinese goods. They will relabel them and send the goods on its merry way to the US. So if China manages to weaken the RMB by 5% and the country faces only a 10% tariff, a huge chunk of the tariffs get taken away, and the amount of profit is still huge for both the Chinese supplier and the middleman. So there are still many cards left in China's deck. Currency is a big one, but we can be sure there are more tricks left in the book. We just don't know about them right now. But let's touch on a big financial reckoning coming for US markets. Now, a month ago, Moody's themselves pulled the trigger on US debt markets. Since the 1900s, the US had a pristine debt rating, even after two world wars. But since 2008, ratings agencies decided enough is enough. They all realized that the US will spiral down into default. And the final shoe dropped during Trump's term thanks to the big beautiful bill that will add trillions to the national debt. And a big shout out to our sponsor today, Indigo Precious Metals. When it comes to buying gold and silver, I trust Indigo Precious Metals in Singapore. They have made investing in precious metals safe, fast, easy, and simple for both small and large scale buying. I've been stacking gold for over a decade now, and I've learned two things when buying. You want to buy authentic gold bullion, and you want to buy it at the lowest premium possible to stretch your dollars even further. And I'm glad to say I found both of this at Indigo Precious Metals. Indigo Precious Metals is a leading retailer in Singapore. They specialize in physical gold, silver, and platinum. They are my one stop shop when it comes to buying bullion. Their prices are sharp, and they have the best brands on sale, and I can test the gold on the spot. So if you're looking to make your first gold purchase, Indigo Precious Metals is the best place to start. Whether it's 1 ounce or 1 kilo, this is the reputable dealer you are looking for. So take action today. Click on the link below and enjoy a discount on your first purchase with the code SEANFOO. Start your gold stacking journey today. But that isn't the end of the road. Legendary investor Jeff Gundlach is now warning of massive risks in the US corporate debt market. Companies borrowing money could be facing big trouble in the months ahead. Now, junk bond spreads today are narrowing down like never before. They are only at 3% today, and that is not a good thing when we consider all the risks that are coming from tariffs and the Israel Iran escalation. Now, all these are not priced in yet. Everything is hunky dory in investor land, and investors they are putting a big premium on corporate debt. Valuations are still at nosebleed levels. And when the US government imposes tariffs on importers, this puts a tremendous strain on your finances. When companies place an order with a supplier, they don't pay up immediately. If you're a vendor or you deal with vendors, you kind of know what I mean, right? Payment terms are anywhere from 30 to 60, maybe sometimes even 90 days. So you do have some breathing room to maneuver around. But when it comes to paying the tariffs, companies need to pay in cash to US customs. It's not like you can defer it for months down the road. You have to pay on the spot for them to release your goods. In May, the tariff revenue hit an astounding $22.8 billion. That's a lot of cash being paid to the US government. It's not China paying the tariffs, it's money going directly from companies to the Trump administration. It's a big drain on corporate cash flow. The US government is taking away their cash at a time when consumer spending is falling, is failing. So there are cause and effect to this tariff war. Corporate balance sheets are getting hammered, and Gunlock is worried that investors will get trapped. Sooner or later, the payments will be due, but do the companies in question have the money to pay back bondholders? Now, cash levels for the S&P in Q1 fell by 1% versus the same period last year. But this is just from January to March. Once we count in April to June Q2 this year, we can expect cash levels to drop dramatically. And this puts companies in a bind. If tariffs rise and customers walk away, you are facing a double squeeze. Higher expenses and lower revenues will do a number on many companies. They will be forced to burn through their own reserves. So we are witnessing in real time more dominoes being stacked against the US economy. Now, this might just be the trigger that takes down the financial system. And by the start of July, $50 billion worth of debt will be downgraded. They will fall from investment grade bonds down to junk bond status thanks to ratings cuts. And that is like crossing the Rubicon. When your debt gets cut to junk, it signals to investors that you are a high risk borrower. So naturally, your rates go up. Investors will demand a higher premium to lend you money. And if rates were 7% before for you, it's probably headed up to 8, 9, or even 10% or more. And that's how damaging the tariff war can get. If we can get the rates down, then the risk of a default goes away. It's also imperative for the Israel-Iran conflict to de-escalate and not spiral out of control. And just yesterday, we thought things were starting to de-escalate. We had a glimmer of hope that a ceasefire was about to come, but no, that just isn't going to happen now. Israel has vowed to continue pummeling Iran, and Trump has left the G7 meeting suddenly. In fact, we are beginning to see a revival of the oil crisis. Crude oil is back up above $71 for West Texas. Why? Because Trump told everyone to evacuate Tehran immediately. So is a huge strike coming within days, maybe within hours? Him leaving the G7 meeting and scrambling back to Washington is very ominous. Something big is coming and the US economy can't withstand yet another hammering. Now, the price spike on June 13 was the biggest jump ever. Since the conflict started, we saw crude rocket up by 13%, and this time oil and energy infrastructure are being targeted. So the domino effect really is clear here. Higher inflation equals higher rates, destabilizing for the bond market. But people also get broke, their budgets dry up, so they spend less. At the end of the day, this hurts companies even more. Less cash circulates, more downgrades, and potentially more defaults. And this is just from an inflation shock. However, the persistent risk is still the tariffs. On that front, Trump is still acting like the king of the world, which is very unfortunate.
Look, we have our trade deals. All we have to do is send a letter. This is what you're going to have to pay. But I think we'll have a few new trade deals.
Now, sending a letter for trade deals isn't going to cut it. Ideally, Trump will have to extend the pause and iron out solid trade deals that he doesn't U-turn on just a week later. The world needs certainty. Businesses need certainty so that they can plan. But more importantly, consumers like you and me, we need certainty before we go out and spend. Now, the Penn Wharton budget model does a fantastic job of projecting the damage of Trump's tariffs, not just on consumers but on companies as well. And let's work on the assumption of the tax burden getting split between consumers and corporations equally. 50% falls on the buyers and 50% will be shouldered by companies that will eat the tariffs. And in this case, by 2030, domestic consumption will fall by 2.8%. During the same period, the average wage for workers will drop by 1.4% as well. And when people earn less, they obviously will spend less as well, so there's a trickle-down effect to this disaster. As time goes by, the effects will start to get worse and worse. By 2054, consumption will crash by 3.6%, and wages will drop by nearly 6%. So we are looking at a US economy that will be less robust than before and an economy that's slowing down. And once again, the risks are starting to pile up, and on the two most dangerous fronts is not looking good. The oil crisis is still not over, and his tariff plan is just plain bonkers. But let me know what you think. Will China keep weakening their currency to counter the US? And are US bonds in deep trouble? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.